Hi, friends. I'm back. Sorry, there was a little bbit of an internet issue because of which I got disconnected. So, moving on to the next question, which I was answering, um, uh, it is about how to know which place is safe to get loans from. Well, that's a very good question. I would say that you should always take loans from either established banks or you can go to non-banking financial companies, the NBFCs. So some of the NBFCs would be Bajaj Finserv, Chola Mandalam, and you would get a lot of these entities over there. What you should never do is go for loans from individuals. It's not safe. You don't know what's the source of the money. And if the lender gets into some kind of trouble, then obviously you might get into trouble as well. Alternative One alternative source of loans that has come into the market is there are a few peer-to-peer lending platforms which give loans, which mobilize loans from people, give loans to other people. You can go for them. However, the problem there is that the interest rate that you pay is higher than what you pay to the banks. So ideally, I would say that you would get the market interest rates from the banks, and that's where you should be taking loans from. Anywhere else that you go where you don't have to give any collateral, the interest rates would be higher. So actually, it depends on whether you have collateral or not. If you are taking a loan for your company, you should have some collateral, and the banks would be the safest to do. Next question is what is the best way to start understanding how stock market works if I only have small amount of money, anything between say 10 to 50,000 rupees. So I think this is my favorite question because I answer this very often to a lot of people. See, what happens is, let me start by explaining what are stock markets. What we see is, what we see on CNBC, the tickers are going, and Sensex is going up, Nifty is going down, and we feel that okay, people are putting money here and then they're buying and they're selling during the day, and that's what stock market is. But no, that's just what we see as stock markets. Stock markets are a collection of all the companies in India which are listed. Okay. So, for example, we are all entrepreneurs and we all have a company which we are running. If it is in a company format and we decide to do an IPO tomorrow and get it listed, it will become part of the stock market. Now, there are two ways in which stock market investing currently works in India. One is what we see 90% of the time around us, where people are, buying something in the morning, selling in the afternoon, or buying and selling after 6 months. So that is basically trading, right? And that is speculation. You have to understand how you make the decision before buying a particular stock. So, in trading or speculation, people buy or sell a stock only based on the price of the stock. They will never really think about what the business the company is in, who are the promoters, what kind of revenues are they making, what is the cash flow, what is their strategy going forward, will they keep growing at double digits. So they don't look at those kind of questions. They only look at the 52-week high, low, and some other metrics, and then decide their purchase and sale transactions. Now, typically, those individuals, while they form the bulk of Indians who trade in the stock market in terms of numbers, I would say that it's very difficult to be able to predict whether a stock will go up or down, in a matter of say few months, because what happens, the pricing on the exchange is determined by demand and supply of the shares. Now, demand and supply is influenced by a number of variables. That is what is true in short term. So, in the short term, which is few months to say 1, 2, 3 years, you will see a lot of volatility in the stock market, and hence, whatever decision you take to buy or sell a stock is nothing more than luck, or nothing more than like gambling, right? You can actually play poker and you would have the same kind of decision making skills over there as compared to your decision making skills in a stock market. So what I suggest for people who want to take equity exposure, they should actually go for equity mutual funds. See, the reason are multiple. One is that if you want to directly buy stocks in the stock market, then you will need a large amount of money to buy 20 stocks. And if you are buying just one or two stocks, then obviously you are taking a huge amount of risk. As opposed to this, mutual equity mutual funds typically hold a set of 25 to 35 stocks in one single fund, right? So even if you are investing 1000 rupees in an equity mutual fund, you are essentially getting exposure to all 25-30 stocks. Now if those 25-30 stocks do well, your 1000 will also grow, right? So, and that's the first thing, that you get diversification, as opposed to the limitation of investing your money in one to two stocks if you decide to do it on your own. Second is that equity mutual funds are managed by expert fund managers. Their job is to research each company, not just from the pricing point of view, but also from the business, management, future, cash flow, strategy point of view. Now, when you do that, you end up picking companies which you think are going to do really well over a period of, say, 5, 7, 10 years. Okay. Now, when they pick such stocks, they don't pick stocks to sell them in a year's time or 6 months' time. They will typically hold these companies for a very long period of time. And that is how returns in the equity mutual fund get generated over a long period of time. So, if you are someone who is wanting to invest in equity for anything less than 5 years, you should stay away from equity. You should not go for equity. It is very, very risky. But if you do not need your money for at least 5 years, you should go through equity mutual funds. Coming to the next question, do freelancers have to pay tax? Very interesting question, given that a lot of us are into freelancing now. Yes, freelancers do need to pay tax, depending on the nature of the income that they disclose in the return. So, if you are disclosing yourself as a professional, then your taxation would be covered under gains and profits from profession and business, and you will be accordingly liable to tax. But yes, just because you're a freelancer, you don't get the benefit of not paying tax. But if you're a freelancer who's earning up to 2,50,000 every year, then obviously your income is exempt from tax. But if your income is more than that, then you obviously need to start paying tax. Coming to the next question, how can I earn rupees 50,000 monthly with just investing? Well, what you earn depends on what you invest, right? I know a lot of advertisements actually talk about earning 1 lakh a month by investing, and like 2 lakhs a month by investing. Let me tell you, it's not investing, it's trading, right? And when you trade, whether it is stock market or it's commodities or it is bitcoins, it's all speculation. When you are speculating, there is no rational reason behind why you purchase or why you sell. The reason I say this is because I've seen trading very, very closely. I have seen that there is no rational why people buy a stock. And if we ask them 10 questions, they don't have any reasons why they bought a stock. The only reason they have is that they think the stock will increase in price, but there is no reason behind why they think so. So, making money from trading is always 50-50% chances. You can make money one day. I'll tell you what happens from a behavioral point of view. Say, for example, you start trading and today you make 20,000 rupees. You will naturally feel that yes, this is what you should be doing because this is very lucrative and this is easy, and you understand the markets. You start trading. Someday you lose 5,000, someday you gain 35,000. Now, when the markets are going up in general, most of the people who are trading will feel that they are making a lot of money. But the problem they face is not being, because they don't have any rationale behind why they have purchased the stock or why they want to sell the stock. They will face a huge amount of problem when the markets are very volatile, or they are like in a correction phase. So currently the markets, they are uptrending, but approximately 2 to 3 months back they were very, very volatile. So people who are buying and selling on a daily basis, they didn't know where the markets will go today. So all they were doing was sitting in front of the screens, looking at the tickers, and like just hoping that the markets go up. But it doesn't work like that. You can actually read one of my articles on trading, which I've written on our blog for CAGRfunds.com, and you can see how it becomes very, very risky for people. Coming to the question of earning 50,000 from investing, well, I would say that you can go for a monthly interest kind of a situation where you invest in a fixed deposit and it gives you a monthly interest or a quarterly interest that you can take out. But I would say that for getting an income of around 50,000 per month, you would need a huge amount of money to be invested in a fixed deposit. And also, this income will be taxable, which will not be very, very beneficial for you. So, what I would say is that you should not actually expect a monthly income from any investment vehicle, because to truly generate enough returns, you need to give time to your money. You cannot expect that you invest 10 lakhs today and you start getting income today. It does not happen like that, except for fixed income instruments for where you need to invest a huge amount of money to get an income around 50,000 rupees, right? So what I would suggest is, if you have surplus income already, you should take a step by step approach. You should take a planned oriented approach to generating income in future. See, most of the investment instruments are to safeguard your future. You cannot really safeguard your present by investing today. It doesn't work like that. So you'll have to work hard to invest, work hard to save, then invest. And because you give time to your investments, your future gets safeguarded, right? So you cannot make investing your source of daily income right now. But what happens is, you should target that whatever investments you have made, the interest or the income or the dividends that is being generated out of that can suffice your future expenses. So maybe not today, but maybe 10 years down the line, you can actually live on your investments. Today you can live on your investments if you already have a surplus cash where which you can invest somewhere. So unless I know what investment you can make, very difficult to say how can you make 50,000 by investing. I hope that answers. Next question is, why are most people broke in tax month? I would say because people, kind of not plan for tax beforehand. So, in my experience, a lot of people wake up to tax planning only after December. For salaried individuals, it is true because they have to give the tax proofs to their employers. And for a lot of other people who are not salaried, they really wake up to tax planning only in March. Now, when you do that, you obviously, in order to save taxes, you have to invest certain amount of money in tax saving instruments. Now, when you invest some amount of money in tax saving instruments, and when you do it at the last minute, you obviously take out. So your earnings every month is limited, right? Say for example, you are earning 50,000 rupees every month, and you just woke up to tax planning in March, and in March you have to invest 1,50,000 rupees to save your taxes, right? So but then your earning is limited to 50,000 every month. So but you need to invest 1,50,000, so you have to get 1,50,000 from somewhere to invest, right? And then what will you do? You will dig into your savings from previous months, take out 1,50,000 and invest. Now when you do that, you obviously go broke in the tax planning month. So the way to handle this is that you should actually plan for taxes right in April for this entire year, and you should start investing in the tax saving instrument throughout the year. Investing at one particular time, see, it has multiple disadvantages. One is, if you are investing in the equity mutual funds, then you actually lock in a price which might not be very good for you. If you are investing in any other instrument except PPF, then those instruments might not be the right instruments for you. So a lot of people actually get locked into ULIPs and LIC policies towards the end of February and March, and that is because the only focus is on tax planning. They do not realize that whatever money they are putting into the LIC policies or the ULIP plans will end up not making so much return what they deserve, and their money will not be their money, they're not putting their money to the right use, or to good use, I would say. So you cannot just think of only saving tax and not generating returns on your money. It's your hard earned money, you should generate returns on the money. So you have to think from a dual perspective, and you can only do that when you have time in hand. So I would suggest that you should start, for people who have not started their tax planning, they should start tax planning right away. And in case you need any assistance in tax planning, feel free to write to me, and we can get on a call to discuss how you should be planning your taxes. Coming to next question, I think it's from Harshita. What is, as a financial advisor, what is the most common mistake you see people making with their personal finances? Thank you, Harshita, for asking this question. I don't think really people, I think people don't really realize that they make financial mistakes. So one of the things that I will say, and I do post on the Shiro's community also, is that a lot of people want to start investing, start saving, start budgeting, but they'll call you, they'll discuss with you, but when it comes down to doing, they just fail at doing, or they just procrastinate doing, because something else is always more important. So maybe today, you have to go to your relative's place, tomorrow you have to go shopping, on the third day you have to go to your kid's school, fourth day you have some important assignment coming from the office, and you just keep postponing your saving day by day, day by day, day by day. But you, in your head, you feel that yes, I'm planning to invest, I'm planning to save, and that whole delay actually runs into years and years. That's one kind of delay. Second is the kind of people who refrain from investing because they always want access to the money. They want that I should have my money whenever I want. Now, when you want that kind of a liberty, you can obviously not let your money be in an investment instrument for enough number of years for it to grow. You have to give it time to grow. Just like any skill set that we acquire, we need time and experience to make it better and better. Similarly, you need to give time to money to grow, especially for instruments like equity mutual funds. Not very true for debt mutual funds. Over there, the volatility is not very high. You can actually save your money, yeah, and withdraw whenever you want. But that is saving. That is not investing. And there is a difference between saving and investing. Saving is that you want to put 10,000. You want 10,000 to remain 10,000, or maybe become 10,500. Investing is that you invest 10,000 and you want it to become 20,000 after a certain number of years, right? So investing needs time, saving only needs discipline. So I think the biggest mistake that I see people making is to not have discipline to start saving and budgeting, and not give time to their investments. And that is the reason people face a lot of losses, and they feel that the equity mutual funds are a bad instrument, or some other instruments are bad. But it's not that. It's your internal behavioral trait that is making you take the wrong financial decisions. I hope that is answering the question. Next question is, if I take early retirement and withdraw my PF, is it taxed? Okay. I think I'm not very sure on this. I think I'll have to go back, research, and come back. But premature withdrawal of any retirement instrument is generally taxable. But PF is a tax exempt instrument. So I would fear that it would be taxable. I think it is not taxable if you are withdrawing for some purpose. But I will, and what I also think is that even in case of early retirement, you can only withdraw a certain percentage of the PF. But I'm really not sure on this question, so I think I will just go back, and whoever has asked this question, please write to me on my email address, and I will definitely find this out and get back to you. The next question, and perhaps the last question for today, is it's a 35-year-old Indian woman. I have saved 50 lakhs rupees after working for 12 years. How much should in average Indian woman of my age have saved? So, it also depends on. So, you've been working for 12 years, right? See, it's not about how much you should have saved. There is no absolute number to that. It totally depends on how much you were earning. I would say that on a monthly basis, you should at least save 20% of your take home salary. So, whatever you are taking home, you should invest at least 20% of that. It's It's the basic minimum, and it's very important. If you've been able to do that, over a period of 12 years, I think you've done a good job. If you've done more than that, excellent job. If you've done anything less than that, well, I would say you could have done better, but there could be circumstances why you did not do it, so that's okay. What is more important for you is that now that you have saved 50 lakhs, how are you really putting it to use? You are just 35 right now. You would have, you should be actually parking this money for certain goals that you have in life. You could have a goal around buying a property, or securing your retirement, or for any, n number of other goals. You should actually be deploying your savings to those goals. It's very, very important that you do that. So, guys, thank you so much. It was lovely catering to so many questions. It's great to know that so many of us are struggling with so many queries that we have in mind, and we don't really find someone to cater to them, clarify them, and it's just lovely to be able to clarify them, be of any value to you. Please feel free to reach out to me on my coordinates. You can drop me an SMS, a WhatsApp, or an email in case you need anything. Thank you.